Hello and welcome back to the ROI channel, a channel that's obsessed with the art and science of return on investment. And today, just an update and a review for the performance of the portfolio on eToro, trying a bit of a different setup. So just such a nice morning. Got up bright and early. You may hear the odd crow in the background. Disclaimer, guys, obviously nothing I say here is intended to be advice. This nor does it constitute advice. This is just me, my opinions of what I'm doing, giving my thoughts and updates out to the world. Do your own due diligence and consult your own professional financial advisor as appropriate. So, review for July, Crassus Investment, which is the portfolio that you can follow on eToro, was up 10% on the month, or up around 15% year to date. Volatility is the name of the game in terms of cyclicals in the current economic environment. Continue to stay the course in terms of strategy. My private fund up 4.13% for July, up 8.55% year to date. Okie doke. So here we go. A few charts here. A lot have been taken from Tavi Kostek at Crassus Capital. His Twitter link is in the bottom of the slide here, will be in the description. Highly recommend you guys follow him on Twitter if you haven't already. And every Friday, I believe, for me, the boys at Crassus put out a video update, and they're absolutely worth their weight in gold. Definitely spend the time to listen to their presentations. What we're looking at here, we've got on the white is the NASDAQ melt up that people were laughing because old mate David Hunter actually got it right finally in terms of this melt up. This is not a fundamental rally. I don't know how, other than perhaps some short covering, I don't know how the NASDAQ continues to grind higher. When you look at the price of treasuries continue to drop and the yields going higher, this will have to converge at some stage. If you look at the correlation and you look at these alligator jaws, the alligator doesn't keep its jaws open forever. And in this case, rather than the price of the bonds being bid up, i.e. people coming in buying more bonds and lowering the yields for the red line to catch up to the white line, I think it's going to be the other way around. I think the white line is going to come down towards the red line, and that can have some serious consequences. If we take a look here at I call it some monetary indicators, okay, or currency indicators. If we look at the Fed funds rate at the top, that has increased 100% rolling 12 months. We're looking at the 10-year and then the 30-year down the bottom, the orange and the green line, up 53 and 44% respectively. This is the cost, this is the yield on these bonds, okay? So these bonds are getting smacked. The yields are rising. The cost of this capital is rising. Why? Because the yield, the interest needed to pay these bonds, we're talking about the US government's cost of funding, essentially. And so that'll get seeped out into the financial system. So if the Fed funds rate increases, the rate at which banks have to pay to borrow that money so they can then lend out and put their margins on their loans in the commercial and retail sectors obviously have to be higher than what they're getting their capital base from. And so the higher their capital base rises in terms of cost of capital, that cost is going to be passed on to the consumer and corporations. And so if we're thinking about corporations, i.e. the stock market in general, broad equities, their cost of funding has just gone up significantly, which means their margins are really going to be squeezed from their ability to access capital. They're not going to be able to service that capital because it's becoming more and more expensive to do so. Right at the time where we think that the economic consumer demand spending is going to slow, if not recede, into a recession. Gold at up 9% rolling 12 months. And then you see the Dixie and then crude oil down the bottom. So we're going to talk about crude oil a lot today. Dixie is the US dollar measured against a basket of currencies. It's dropped a little bit due to the fact that it was so strong. It'll be interesting to see what happens, because as these bond yields rise, normally you would expect capital to fly into those instruments. The issue is one of the reasons why those treasuries, particularly the 10-year and the 30-year, are increasing is because the US government has to fund its debt. It's raised its debt ceiling, and they need to issue more treasuries onto the market. So they may not be lowering interest rates. They're simply putting more bonds onto the market. And less people outside of the Fed are buying those bonds. So it's going to be very, very interesting. Normally, you'd expect capital to flock towards these high interest instruments in US dollars. But if there are more and more of these instruments, they start to lose their value. So what that will mean for the DXY remains to be seen. Okie doke. So here we have, I guess, a few interesting commodities to look at. Silver is up 25.8% on the year. Finally, my silver holdings are starting to play out. It's just a volatile ride. Uranium up 22.5%. We have a horse in that race via the URA ETF. Copper's up 16.5%, rolling 12 months. I would love to get some exposure to copper. I still think there's more weakness ahead, and I'm trying to work out the best way that I can play that over the next 1 to 2 decades. Copper is certainly going to be needed in increasing demand, and it's a real it's a bitch to start a copper mine, basically. So it's going to be really challenging to get the supplies needed. And so I think copper is an interesting play, to say the least. Gold, 13% year to date. This little green line down here is the Aussie dollar getting absolutely pumped. And so if you were an Aussie and you took your Aussie pesos and you put them into gold, you would have saved yourself about 1% in terms of capital destruction, all else being equal. Crude down 16%, and wheat futures there down 20%, rolling 12 months. I want to talk about oil because A, I love it, and B, I just think it's its time. If we look at the break-even rates since before 2015, 2014, what we're looking at here in this chart, the break-even rate is the tips difference between the tips and the 10 years. So the Treasury inflation protected bond versus the bond. And so what it shows is an indication of the market's expectation of said inflation. So as you can see here, oil and the 10-year break-evens track fairly closely. Expect that to continue to do so. And what I've done here is taken that idea and put it out over the rolling 12 months using the break-evens and then crude futures. Why that's important is if you look at crude is down, on the front month over this period at least is down, whereas the inflation expectations, okay, and the 10-year break evens are up 4%. And I would expect this to converge to the upside, given that I don't believe, although the market's telling us that we expect higher inflation for longer, and oil will catch up, being a really core part of that inflation. Moving on to oil news this week. Yesterday, I woke up to the news that there was a 17 million, the IEA did their normal revisions, a 70 million barrel crude draw. This is the largest in history. So out of the inventories, 70 million barrels went out the gate, and the price of oil went down 3% on the day. So it goes to show you that there's a disconnect between the financial and the physical market. But if we look here, I mean, look at this crude storage. It's just getting, pardon the pun, really scraping the barrel here. And something needs to be done. And the relief from this is going to be high prices. It just is. You see the Saudis announcing their cuts, continuing their cuts. The Russians finally are getting harder and harder to sneak their crude onto the market. It looks really, really tight towards the end of the year with regards to oil supplies. I'm going to talk about what I plan to do about that. What's happening with the supply? Are we having more and more supply being pumped online? Well, actually, no. Again, from Crescott here, we're looking at oil and gas operating rigs, and we can see the steepest decline since COVID, basically, since 3 years over the last month in June. And I can only suggest that this is in anticipation of a drop in demand growth with a recession. And I'll say it, I said it before and I'll say it again. If you look at work done, looking at oil and gas demand, it's not the demand that gets, you don't have a real drop in demand during a recession unless we're talking something as bad as 2008 and 2020, so the GFC and COVID. So if you believe that we are not going to have something as bad as the GFC or COVID, this makes no sense. what happens, generally speaking, in the face of a recession is the rate of growth of oil demand is what drops. And if we look at 2008 to 2009 to 2010, or if we look at 2020 to 21 to 22, we did see the real drop after those major events. And then we saw the rebound in oil demand come right back up. With the rigs, the rig count really dropping, the ability to get more supply online in the event of what I think this tightening physical market towards the end of the year is actually going to be less. So it really could lead to a scary blow off top. US state local income tax receipts. Why is this important? Because taxes are your cost of government. And so when the government is broke, which it is, and the interest on their debt rises, which it is, they have to try and get money from somewhere in order to service that debt. Tax hikes, I believe, will be coming. We got an election in the US next year. So the question is, all else being equal, you would want to decrease your exposure to US broad equities. The issue is that it's the biggest, most important, most liquid market in the world. And so how do you benefit from a rising US dollar in the short term, and avoid getting smacked with corporate taxes? That's something I'm pondering. And whilst the US is the most interesting market still, and it will be for quite some time in terms of the overall size of the thing, exposure to broad general businesses in the US is not what I'm looking at. Certain commodity producers, yes. Outside of that, I'm looking further afield, as I've spoken about with different LATAM producers and explorers. Agricultural commodities. So if we look at weather commodities, which is the raw input for food, we have, again, this alligator jaws, this disconnect. I do not believe that's going to stay the same. In this case, I believe that commodities are going to hold, if not rise, in the face of a higher inflationary environment and a lack of sustaining capex. And so, unfortunately, I think food is going to get a hell of a lot more expensive, and that blue line is going to converge towards the yellow line. What's the consequence for the portfolio? I'm still long wheat futures. I took profits, wheat dropped down. I've gotten back in. I hope I'm not going to get chopped up with that trade. I don't think I am, but we'll see. Fertilizer is the longer term way that I'm playing it. Currently, we have a position in Mosaic. And general low margin recession stocks, I'm actually avoiding. If I'm not interested in, like, BJ's Wholesale Warehouse, we've owned and done well in the past, certain low cost food providers, supermarkets, I don't see it. I see that it's going to become a harder economic environment for these businesses, and their margins are going to come under a lot of pressure from rising goods costs, services cost, and cost of capital. Inflation is really going to kill margins of these businesses. So we've spoken about the US and why, let's say, the cards are not necessarily stacking up in that market's favor. One market I've spoken about a lot on Twitter or made certain comments is Latin America in general, but particularly Brazil. Brazil looks incredible right now, since various factors, the sell-off, the Lula, I guess, fear, none of that has come to pass. It's been amazing to watch. If you look at the Tavis chart here, and he ought to know, being Brazilian, you look at the Bolsa's price versus the multiples, the PE multiples on said index, things look very, very cheap. Down the bottom here, looking at these blue lines, is the median PE, so the average amount of dollars you're paying per earnings of these companies, versus at the top, the yellow lines, the overall market cap or market quote for the index, the Bolsa itself, in US dollar terms. It's just broken above that resistance line if you're a technical guy. Me, I'm more of a fundamental value guy, and I just look at that little blue line being less, like being in single digits for an emerging market with enormous endowment of natural resources, not geopolitically tied to any one particular country. They're a member of BRICS, but they can deal with the US. They've cornered the offshore rig markets. There's a lot of exploration and development of their resources down there, and very long Brazil, especially in resource stocks. Major changes to the portfolio as of this month. I'm looking at Callum Petroleum. It's really annoying. It's frustrating. it's a huge discount to book. I've sold it out because if you see my interview with Josh Young, we talk a lot about vital energy, and I just think it's a better play, relatively speaking. And so why would I have money tied up in Callan, even though I've taken an 18% loss? If you read The Art of Execution by Lee Froman Shaw, you've got to have a decision. Usually it's around that 20 to 30% mark. Do you add, do you keep, or do you cut? And so what I've done is I've cut and I've rotated into, or I will be rotating into some of these three positions. I've added Vermilion to the portfolio. It's extraordinarily cheap on most metrics. The issue will be if they get stung by windfall taxes as well. It's a call option without too much of an expiry date on natural gas. Natural gas is just too hard a market. So to get a little bit more exposure to the gas market, Vermilion is the play with which I'm going. And I'll have continue to have a heavy focus on net asset value and total book value. So companies that have hidden assets that are undervalued, decent enough balance sheets and income, free cash flow yields such that they can service any debts, continue to operate as a business, whilst those assets, tangible assets, can grow in value in an inflationary environment. My expectations, second half of the year, I don't think inflation is going anywhere in an aggregate basis. On a year-on-year basis, sure, it can fluctuate. Prices are only going one way. Higher rates, I think corporates really struggle. I really do. It could well be crunch time by the end of the year. We could see a big sell-off in the NASDAQ, in the broad equity market in general, in the S&P. I'm not short in the eToro portfolio at all, because just you've seen what happens with the melt up. It makes no sense. But I will be keeping a decent amount in cash for any particular bargains should they come up. Thank you for watching. If you haven't already liked and subscribed to the channel, please do so. And I hope to see you in another video shortly. Take care.